You've heard what Steve had to say. This is, by the way, not unusual for NVIDIA, is it? NVIDIA, the good folks at Bespoke, your team, you've recognized that NVIDIA will often have these kind of wild swings following earnings. But what is your take right now on these markets?
Well, I think I'm going to kind of add to what Steve said. I think the crypto market has been limping along since October 10th, because on that date was a negative shock. I mean, today's stock market looks a lot like an echo of what happened October 10th. But on October 10th, that liquidation was so big, Brian, it really crippled market makers. And our market makers are critical in crypto because they provide liquidity. I mean, they act almost as the central bank in crypto. And if they've got a hole in their balance sheet that they need to raise capital for, they need to reflexively reduce their balance sheet, reduce trading, and if prices fall, they've got to then do more selling. So I think that this drip that's been taking place for the last few weeks in crypto reflects this market maker crippling. And so in 2022, it took 8 weeks for that to really get flushed out. We're only 6 weeks into it. So I kind of concur. I think crypto, Bitcoin and Ethereum are in some ways a leading indicator for equities because of that unwind and now this sort of limping and weakened liquidity.
Well, that was the point that my very, very smart team behind me, we put together for the top of the show, which was showing that Bitcoin turned down today before the market did. All right, take us back. So October 6th, I think it was October 6th or 7th, Bitcoin hit 125,000. Yeah, a couple days later, it was still around 120,000. Now, obviously, Bitcoin's at 86 and change. So what specifically occurred on or around October 10th that would lead us to where we are now on what, November 20th?
Yeah. Well, Steve actually pointed this out. There's a lot of what they call automated processes in crypto. One of them is called ADL, okay, and that's an automatic liquidation feature that would take place if someone's account or their collateral drops in price. It's essentially like a margin call. On a specific exchange, a stablecoin's price varied from other exchanges. Stablecoin should stay at $1. It dropped to 65 cents. But that only happened within the exchange quotes, within this exchange because of liquidity. That triggered an ADL, an automatic liquidation across many accounts. It wiped out, as that spread across other exchanges, right, because liquidations cascade, almost 2 million crypto accounts got wiped out, even though minutes before they were actually profitable accounts.
So who is behind this? Like, who's the they in the market makers and they got hit? Who's the they?
Well, Brian, I am aware of names, but because, I'm not someone who wants to name names, I think what you should keep in mind is that this error is actually essentially a bug, a code error, because I think in retrospect, they would have pulled pricing from across exchanges to set the price for that stablecoin rather than relying on internal quotes. But this has resulted in a lot of market makers and traders having less capital. And as you know, as crypto prices drift lower because trading volumes drop, they need to then have more capital available, which means they shrink their balance sheet further. So this is then that reflexive weakening.
I want to go back to this point, Tom. I hate the term glitch. I can't stand the term glitch because, things go down at the airport and they say, well, a glitch caused your flight to not take off. That's not a glitch. That's more than a glitch. It's a word that is used to describe pretty serious automation issues, software problems, crashes, for some reason that they try to minimize. Is this some kind of a software bug that's causing part of this? I'm trying to follow exactly what you're hinting around about.
Brian, it is. For instance, in 1987, portfolio insurance was the, quote, glitch. And that triggered the
question about your takeaway from this morning's jobs report.
Well, we've only had a short amount of time to break down the report, and it's only just one number. Again, we don't make too much of any one individual report, and this one is a bit stale. It's a bit dated because it comes from September. It does look like it was a mixed report, but it's in line with my expectation that we would see some further softening in the jobs market, which just highlights the difficult time that this is for monetary policy, because we are seeing some signs of softening in the labor market, but we're still seeing elevated signs of inflation. And so we have to balance those two things as we're looking at our dual mandate.
Yeah, the operative phrases have been downside risk to employment and upside risk to inflation. So let me just probe a little bit further on this issue of downside risk to employment. You got a pretty robust payroll number on the one side, but the other side, kind of like the Rorschach test of this thing, which is that they had an 11 basis point increase in the unemployment rate. Does this increase your downside, your concern about downside risk to employment?
Again, it's one number,
Sure.
and we try not to make too much of any one number, and I try to round it out with a variety of other data. So the unemployment rate and this BLS payroll report is the gold standard, so it's great that we're getting this data again, but we have been complementing it with other data, whether it be the ADP jobs data, the WARN notices that we do a lot of research on here at the Cleveland Fed.
Which are layoff notices, right? Just
correct. Those are those are the large layoff notices that come out. And we are seeing that they have been moving up slightly, and so that's something we're attentive to and want to keep our eyes on. But we also really importantly I spend a lot of time out in the district talking with different business leaders and hearing from them about what they're doing. I was down in Cincinnati a few months ago, earlier this month, I think, and we were talking with some business leaders there and some workers about their experiences. And what we hear from the workers is that they're holding on to their jobs for dear life if they have them. We are in this low hiring, low firing environment. But what I also heard at that same roundtable was that the money that they have coming in is just not stretching as far as it used to. That $30, what used to cost $30 now costs $50. And so they really, that inflationary pressure is still very salient for them.
How do you make determinations about what's going on the inflation side in the absence of data? We've used price stats, and without giving a long list of data, do you feel like you have a pretty good understanding of what's happening on the inflation side? I
feel like we have a good understanding of what's happening in inflation. Of course, I would love to see the official statistics because those are the gold standard, and we'll be getting those just on a delayed basis. But the information that we get from being out and talking to various businesses is really helpful. We were talking with a grocery chain in the greater Cleveland region, and they were telling us about how they're managing their prices.
Right.
They're seeing elevated pressures coming from energy prices. And they're thinking about when they're passing, how much of that they can pass on to their clients. Right now, what they told us is that they're seeing much more demand in products when they're offering specials. And that if they're not offering specials, people aren't coming into the store quite as much. So individuals are looking for value.
Downward pressure on inflation.
It does look like there is some softening in demand. Yeah. But in the aggregate, the data that we have on the demand side and on the spending side seems to be holding up reasonably well. So,
but you're a markets person, and I think you come from the standpoint that markets ain't stupid, which is a point of view to have. And they're not telling us very much about concern about inflation if you look at market-based inflation expectations.
Inflation expectations have been contained, which is really a good thing for us. That makes our job at the Fed much easier to do when the markets are thinking that inflation is going to stay and going to get back down to our target. But that's only one factor that we look at. I have to think about how it's impacting individuals. And when I'm out talking to workers and I'm talking to people in the district, what I hear is that the pressure from inflation is still really significant and that they're using their paychecks, much more just for food and housing and energy and, gasoline costs. And they really don't have anything left over at the end of the month.
So when it comes to thinking about December, the way the minutes read was not even evenly divided. It sounded like many or even a majority of board members do not want to hike rates. Where do you put yourself in that?
I walk into every meeting with an open mind, and so we're going to continue to get information. I'm going to continue to do outreach over the next couple of weeks heading into our December meeting. But I will say what I've been saying, which is that we're at a challenging time for monetary policy. We have to balance both sides of the mandate. We are seeing some softening in the labor market, but it's in line with my expectations of what I had thought would happen. And on the prices side, we see inflation that's still too high. And some of the recent indicators that we've seen, albeit somewhat stale, have been trending in the wrong direction. And so to me, I think we need to continue to keep policy somewhat restrictive to bring inflation back down to target.
What are those indicators that you're focused on that have been going in the wrong direction?
If you look at services inflation, some of the recent prints that you've seen in core services ex housing, that's continued to go up. If you look at like a 3-month average over the past 3 months, where that's been trending upwards, not downward.
Hey everyone, hope you're all doing well today. We actually got some interesting news out of Washington, and it could have real implications for Nvidia. The U.S. Commerce Secretary went on Bloomberg and said the administration is thinking about allowing Nvidia's H200 chips to be sold in China. Now, if you've been watching my videos for a while, you already know my view. it benefits the United States when the rest of the world builds on American technology. And whether people like it or not, China is home to almost half of the world's AI developers. So wherever those developers end up building, that's the platform that becomes dominant. Earlier this year, the US blocked Nvidia's H20 from going into China, and that was a wake-up call for Beijing. They don't want to rely on US tech, so they're trying hard to build their own domestic AI hardware ecosystem. But at the same time, Chinese tech companies absolutely want Nvidia chips. They'd plug in the H200 instantly if they were allowed to. They'd even take the restricted H20 if they could. The demand is real. The restriction is political. So if the door opens even a little bit, that would be a surprise upside for Nvidia because analysts currently assume zero China revenue going forward. Now, let's talk about something that's been floating around online. Michael Burry apparently launched a paid Substack. I'm not subscribed, so I can't confirm what he's saying, but people are claiming he compared Nvidia to Cisco during the dot-com bubble. Let me put this into perspective. Cisco during the bubble traded at a triple-digit forward PE. Nvidia today trades in the 20s. That's basically a normal market multiple for a company growing at this speed. And the funny thing is, Nvidia usually beats analyst estimates, which means the real multiple is even lower. And this brings me to the bigger misunderstanding that keeps showing up online. People want to compare today's AI cycle to the dot-com bubble, but they ignore the key differ. Gavin Baker made a great point about this. At the peak of the dot-com era, 97% of all fiber optic cable was sitting in used, dark fiber everywhere. Oversupply. No demand. Today? There is not a single dark GPU. Every GPU Nvidia makes is sold before it even leaves the factory. The world is desperately short on compute while AI demand is exploding. The dot-com bubble was built on hype without usage. This AI cycle is built on insatiable demand and a massive shortage of supply. Could some corners of AI become bubbly? Yes, of course. But calling Nvidia a bubble completely ignores the fundamentals. Now, Nvidia is presenting on December 2nd at the UBS Global Technology and AI Conference. These institutional events tend to move the stock because big money listens closely, so it's worth keeping an eye on how the market reacts. Recently, there's been noise about Nvidia's accounts receivable and DSO numbers from their latest earnings. Honestly, this is not something to lose sleep over. Their DSO was 53 days, perfectly normal for a company scaling this fast. Many networking and AI infrastructure companies have even longer payment cycles, 60 to 70 days or more. Same with inventory levels. Nvidia is ramping Blackwell Ultra, preparing Rubin for 2026, and scaling production massively. When demand is much higher than supply, rising inventory is just part of a very normal, very healthy growth cycle. Now, let's zoom out. Short term, nobody can say what Nvidia's stock will do. It could pull back, it could spike, it could move sideways. That's just market noise. Long term? I think Nvidia still has a lot of room ahead. I don't see overvaluation here, and I honestly believe most analysts are still underestimating Nvidia's future businesses, especially physical AI. Their CFO said this segment represents a multi-trillion-dollar opportunity. And I completely agree. Physical AI could eventually overshadow the data center business we talk about today. Think about it. Nvidia powers the training of AI models in data centers. Nvidia powers the simulation of those models in Omniverse. And Nvidia powers real-time AI inference on robots and machines using AGX systems, even offline, even out in the real world. That's an end-to-end platform, and more than 2 million developers are already building on Nvidia's robotics ecosystem. This whole area is flying under the radar right now, but by 2026 and 2027, it's going to get a lot more attention. And if that's not enough, Nvidia's product roadmap is crystal clear all the way to 2028. Blackwell Ultra ramping now. Rubin in 2026. Rubin CPX later in 2026. Rubin Ultra in 2027. Feynman in 2028. Jensen himself expects $3 to $4 trillion in global AI factory build-out by 2030. This is not slowing down. In fact, the TAM is getting bigger every year. With all of this considered, I don't think we're anywhere near a bubble burst moment. Nvidia has a long runway, and I genuinely believe the company will be worth far more in the future than it is today. Stay calm out there. Keep the long-term view. Don't get thrown around by short-term noise. Hope you enjoyed this breakdown. Let me know your thoughts in the comments, hit like so more people see this, and if you haven't subscribed yet, it's free, and you can always change your mind. Thanks for watching, and I'll see you in the next one.